In this video, we will learn how to replicate the performance of owning 100 shares of stock using a specific combination of options. The synthetic long stock is a strategy designed to mimic the profit and loss profile of owning actual shares, often with significantly less capital. To construct this, you buy an at-the-money call and simultaneously sell an at-the-money put at the same strike price and expiration. This combination relies on the principle of put-call parity, effectively creating a position that moves dollar for dollar with the underlying stock. Let's reference the Greeks we covered in Phase 3. An at-the-money call typically has a delta of positive 0.50, while a short at-the-money put has a delta of roughly positive 0.50 as well. When you combine these, the position delta sums to 1.00, or 100 deltas per contract. This means for every dollar the stock price rises or falls, your synthetic position gains or loses exactly $100, identical to owning 100 shares. The payoff diagram for this strategy is a straight diagonal line, indistinguishable from long stock. There is no cap on your potential profit, but equally, there is no floor on your potential loss until the stock hits zero. Unlike defined risk spreads we discussed in Phase 5, the short put component exposes you to significant downside risk if the market turns against you. The primary advantage of the synthetic long is capital efficiency. While buying 100 shares of a $100 stock requires $10,000 in cash, or $5,000 on standard margin, the synthetic long might only require a margin requirement of 20% of the underlying value. This frees up trading capital for other positions, but you must remain disciplined to avoid over-leveraging your account. However, traders must be aware of assignment risk and dividends. Since you do not own the shares, you do not receive dividends. In fact, if you hold the short put through an ex-dividend date on a deep in-the-money position, you face assignment risk. Treat the synthetic long with the same risk management respect as holding the stock itself, as the leverage can amplify losses just as quickly as gains. Thanks for watching, and join us in the next episode where we explore the inverse strategy, the synthetic short.